Today we're going to talk about real estate investments. So we're really going to talk about three things today. And what I want to address is really the big question of what is a real estate investment? Then the second thing we're going to discuss is how to invest. And the third thing we'll discuss is what type of returns that you can expect as an investor. So on to number one, what's a real estate investment? Well, real estate is an asset class by itself. And real estate is an asset class where you should be able to expect current cash flow as well as upside potential. There are different ways of investing in real estate, and so how to invest in real estate is really number two. There are a multitude of ways to invest in real estate. Real estate has multiple layers, both the physical assets, the underlying debt instruments, the entities that are owning real estate, and investing through those entities, which ultimately own the real estate, investing through the stock market, through publicly traded real estate investment trusts or REITs, and you can also trade through private vehicles like a privately traded REIT. Large funds that are controlled, that are private, not public, but they serve the same purpose effectively as a REIT, but traded through broker-dealers typically. On the physical investing side, one way that you can invest in physical real estate is by investing directly. And you can invest directly on your own, you can invest with other partners, or you can invest in an entity where you're controlling it. But the underlying asset, the real estate, is something that you control directly. So you find the asset, you do the due diligence on the asset, you secure the financing for the asset, and then once you close on the asset, you operate. So you collect the rents, you deal with the tenants, you deal with all the expenses, unless it's a triple net deal, and then the tenant will typically be dealing with those. But generally speaking, you would be dealing with the operations, you would be dealing with the lender, paying the monthly principal and interest payments, and you would be also dealing with any investors that you may have brought on. Ultimately, you also deal with the brokers once you decide to sell the property. So that is direct investing. Another way to invest is indirectly. A way to invest indirectly is more of a passive cash flow strategy. You find good sponsors, good properties that you like, but someone else is managing the operations and the decision making on your behalf. So you invest your hard-earned money with a sponsor that you know and trust, or some property that you like, and then you collect a pro rata share of the distributable cash flow after all of the operations and debt service expenses have been covered. Indirect investing is great for people who have a day job per se, that are interested in real estate or like the benefits of real estate investing without having to deal with the operational side of the real estate business. I know from experience, I've done both. I like doing direct investing, but I also like doing indirect investing. And part of the videos that we'll cover in the future related to diversification are one of the reasons why I like doing indirect investing. And part of that is there are some geographic markets that I just don't know that well. There are some product types that I think are better suited to other sponsors. So I will directly invest in certain properties where I understand the market, I understand the property type, and I feel that I can add value. But I don't do that in all cases. So I'm both a direct and indirect investor. On the indirect side, you are generally investing into an LLC where you will be, or a limited partnership, where you will be either a limited partner if it's a limited partnership, or you will be a member, but a limited member in an LLC investment, and the manager of the LLC or the general partner of the limited partnership will be in control of the majority of the decisions. There may be some There may be some voting rights that the member or the limited partner has, but generally speaking, the managing member, the general partner, is really in control of the decision making of the asset. So that's indirect investing in a nutshell. Another way that is becoming more and more prevalent these days is also an indirect investment, but it's a different vehicle altogether. It's through crowdfunding. And crowdfunding is essentially passive investing marketed to the masses. And effectively, under the Jobs Act that was created by the US government, it opened up avenues where sponsors of real estate investments could market to accredited investors initially. And an accredited investor is someone whose income is $200,000 or more individually, or $300,000 or more annually with their spouse, or that they have $1 million net worth. So it's one of those two criteria that have to be met, and then you can be classified as an accredited investor. A non-accredited investor is someone who's below those thresholds. And originally, under the Jobs Act, crowdfunding was really set up for accredited investors. In 2016, those rules were changed. Now, crowdfunding is open to everyone, both accredited and non-accredited investors, but there are rules in place for non-accredited investors related to their income. It's either a maximum of $2,000 per year that can be invested if you're making less than $107,000 per year, or if your net worth is less than $107,000, then you can invest $2,000 per year. And if you're more than that number, but less than the accredited status, you can invest up to 10% of your income or your net worth up to a maximum of $100,000, which basically meets the net worth test of $1 million net worth would allow you to invest $100,000. But if you have more than $1 million, then you don't have those rules that apply to you. So that is, crowdfunding is basically crowdfunding platforms. They are generally internet-based companies that are almost acting as a customer relationship management tool for the real estate sponsor. They do email marketing, they aggregate all of the financial reporting, the tax reporting, the investor communications, and they also are a platform where you can review the deals that are on offer from the different sponsors and decide if whether any of those deals meet the criteria that you personally have as well to invest. And if you like the sponsor and the deal, then you can invest through the crowdfunding platform and you can invest in those deals and then track those deals and the distributions that you get on a monthly, quarterly, or annual basis. Another way to invest besides investing in physical real estate is investing in debt. And debt, you are investing in an instrument. So you are investing in the underlying mortgage that is on a property. So generally your upside is limited. However, you generally have cushion as well in case the sponsor gets in trouble, that you should be able to take over the property and be able to not lose your money. A common way to invest in debt is generally through hard money lenders, mortgage funds, and even some publicly traded REITs that invest in mortgages. I've invested in debt. I've been a lender and a financier by trade for nearly 20 years, and so I really understand debt. I do the majority of my investing on the equity side, but I do like debt as well, and the reason for that is that it's a steady cash flow. And so if I am getting an 8% return on the mortgage, then that return, I am fairly confident that I'm going to be receiving that over time. Another way to invest is through the stock market and investing in real estate investment trusts. The real estate investment trusts are generally large, publicly traded companies that are investing in certain geographic areas or certain property types. And you can invest through the stock markets of a multitude of countries and invest directly in these companies that are acting as real estate investment trusts. The third point we're going to discuss today related to real estate investment is what kind of returns you can expect from these various investments. So we've talked about current cash flow, and current cash flow is one of the big things that you get from real estate. The other thing that you get is upside potential. Both of those things drive your total return, which translates into a calculation called an internal rate of return, or IRR. And basically that is the time-adjusted return that you get over a certain hold period, taking into account current cash flow on an annual basis, plus the upside profit from the sale of the property or the refinancing or some combination of a capital event. And that also drives another factor which I look at a lot, which is your equity multiple. And an equity multiple is all the total of all the money that you get back from annual cash flow, plus the return from a refinance, plus the return from any sale at the ultimate sale of a property, divided by your original investment. And that gives you a factor to look at. So on current cash flow, the thing I look for is a 6% return minimum. So if I'm getting a 6% preferred return, then I am okay with that. Of course, I'd like higher returns, but 6% is my baseline number that I look at. From an IRR perspective, in the beginning of the cycle, I was looking at IRRs closer to 20%. Now that we're in 2020 and returns have gotten more compressed, I would say that the IRR that I'm still looking for is somewhere in the 13 to 15% range. And on an equity multiple basis, depending on the hold period, I'm really looking to get a 1.75x equity multiple or a 2 equity multiple, somewhere in that range or higher. When you are looking at your current cash flow, you want to look at the amount of money that you get annually and the money that you originally invested. So the current cash flow, you look at that on a year-by-year basis. And in my example of looking for a 6% return, if I invested $100,000 into an investment, I would expect to get $6,000 of cash flow back during that year. So for example, if you invest in a deal and your current cash flow is $8,000, then you have an 8% return on that money. The next calculation is the internal rate of return, or the IRR. And the way that is calculated is if you have a 5-year hold period, and using a similar example, let's say you invested $100,000 into the investment in the beginning of the investment, and in year 1 you got $10,000, so a 10% return. Year 2 you got $10,000, another 10% return. Year 3 you got a $10,000. Year 4 and year 5 you got $10,000, just to keep the math simple. Then on that basis, if that was all you got and you got your money back, you would have a 10% IRR effectively. The math works a little bit lower because of time value of money, but you would have about a 10% IRR over a 5-year hold period. Now, if you sell that property and at the end of that time period, you get $50,000, so you've got $50,000 from current cash flow and you get $50,000 from profit plus your original investment back, you now get $200,000 back. $200,000 over that 5-year hold period works out to be doubling your money, which ends up being a 20% IRR on your money. So the way that's easy to do this, plugging this into Excel makes it very simple. You can plug in your original investment, year 1, year 2, year 3, year 4, year 5, and the money that you get back in year 5, and then you use a X equals IRR calculation, and you can figure out what your IRR is for each property over that hold period, and that is your annualized return over a 5-year hold. So current cash flow plus the profit back and your original principal back, and that will derive your IRR. An equity multiple is similar. So in that example where you invest $100,000 and you get back $10,000 for each 5 years that you hold the property, you've now got $50,000 back. and then at the end of that time period, you get your original investment back plus another 50,000 of profit. Again, you're at 200,000 on your original 100,000 investment. That equity multiple is a 2x equity multiple because it's 200,000 divided by your original 100,000 equals 2. So you've doubled your money in 5 years in that particular real estate investment. And as I said, the numbers I look for in an equity multiple, I look for a minimum of 1.75 and higher, but I try and get in the range of 1.75 to 2x on the money, because that's a good way that you'll be getting close to doubling your money every 5 years, which is my personal goal. So hopefully you enjoyed this video on real estate investing, and you can subscribe below. Feel free to forward it on to friends, and I look forward to seeing you on the next video. Thank you very much.